What's up, everyone? Let's go into Know Your Options. Let's talk about the cash secured put. What is it and how can we use it and how can we trade with it? Let's take a look. So the cash secured put involves writing a put option and simultaneously setting aside the cash to buy the stock if assigned. So this is a stock accumulation strategy. You want to acquire the stock when you run the strategy. The cash secured put involves writing an at the money, so it's near the current strike price, or out of the money, or outside of the current strike price, put option, and simultaneously setting aside enough cash to buy the stock if you get assigned. Now, the goal is to be assigned. That is what you want, because again, you want to acquire the stock below today's market price. Whether or not the put is assigned, all outcomes are presumably acceptable. The premium income will help the net results in any event. The investor is bullish on the underlying stock, let's say AMC or GME, and hopes for a temporary downturn in its price because they want to buy the dip. If the stock drops below the strike, the put may be assigned. That would allow the put writer to buy the stock at the strike price. So let's say GameStop's at $100. You want to sell or write a cash secured put the cash aside to pick up 100 shares of GameStop at $90. So now if the stock tanks to $90, not only do you get the premium from this cash secured put strategy that you have opened, but you get to acquire the stock at the price you would want to if it goes in the money. Amazing. Now, the effective purchase would be even lower. Strike price less the premium received. So you're paying even less because of the premium you get up front. Pretty cool, huh? Now, let's talk about the risks, because there are risks. There are two principal risks. First, the stock might not only dip, but plummet well below the strike price. The investor must be comfortable with the strike price as an acceptable long-term acquisition price, no matter how long the market goes, or how low the market goes. Second, by waiting for a price dip, the investor risks missing out on a stock that keeps climbing upward. The choices then include repeating the short put strategy, possibly at a higher strike price, or closing out and buying the stock outright, or simply accepting that this winner got away. Outlook. Looking for a short-term dip in stock price followed by a longer-term appreciation. That's the outlook you would want when you're running the strategy. Summary. The cash secured put involves writing a put option and simultaneously setting aside the cash to buy the stock if assigned. If things go as hoped, it allows an investor to buy the stock at a price below its current market value. The investor must be prepared for the possibility that the put won't be assigned. In that case, the investor simply keeps the premium received for selling the put option. So if you don't get assigned, you still made money on the premium and you're doing it. Motivation. This is primarily a stock acquisition strategy for a price-sensitive investor. Unlike a naked put, whose only goal is to collect premium income, a cash-secured put writer actually wants to acquire the underlying stock via assignment, hence the term cash secured. The strike price less the premium received represents a desirable purchase price. However, the put assignment is not guaranteed. Should the stock price remain above the strike during the life of the option, the investor will miss out on the stock purchase. The consolation would be pocketing the premium received for the put. If the investor is intent on acquiring the stock and is less concerned about price, there are other strategy choices worth considering that we'll go over later on. Variations. A cash secured put is a variation on the naked put strategy. The main difference is that the cash secured put writer has set aside the funds for buying the stock in the event it is assigned and views assignment as a positive outcome. In contrast, the naked put writer hopes that the put will keep losing value so the position won't be assigned and can be closed out early at a profit. This investor would have to liquidate other assets quickly or borrow cash to be able to honor an assignment notice. Volatility. Whereas an increase in applied volatility would be considered an unqualified negative for a naked put writer, the effect could be described as neutral to slightly negative for the cash secured put writer, all other things being equal. If it now appears likelier that the put will be assigned, greater volatility is a neutral or perhaps even encouraging development. However, greater implied volatility is clearly a negative in the sense that it can raise the put's market's value and thereby the cost of closing out the position. Remember, implied volatility is a measure of anticipated movement in either direction, up or down, and is also considered to be the pricing of an option. Let's say The investor is now convinced the stock will rally instead, and decides to purchase the stock outright before it goes any higher. Unless the investor is prepared to buy even more stock if assigned, the short put must be closed out, and its cost is now higher. Time decay. We all know this one. Theta. The passage of time, this is the good news, will actually have a positive impact on this strategy, all other things being equal. As expiration approaches, the option tends to move towards its intrinsic value, which for out-of-money puts is 0. If the original forecast and goals still apply, the investor keeps the premium and is free to either buy the stock outright or write a new put. Amazing. Passive income. Now, assignment risk. Again, slight. Since the goal of the strategy is to acquire stock, assignment is not a problem. However, early exercise would require the investor to convert the interest-bearing asset to cash in order to pay for the stock. Also, if assignment happened during a particularly severe downturn and the put writer has second thoughts about owning the stock at that strike price, the delay between assignment and notification means that the stock could fall further before the investor can act to limit losses. This is one reason why all option writers have reason to monitor the underlying stock very closely, and be aware a situation where stock is involved in a restructuring or capitalization event, such as a merger, takeover, spin-off, or special dividend, could completely upset typical expectations regarding early exercise of options on the stock. Comments. Investors are told repeatedly to be wary of short option strategies, and quite rightly so. Without question, they entail tremendous risk, far greater than the limited premium income. They are definitely not suitable for all investors and situations. However, here is a short option strategy with risk profile that is identical to the covered call. Though far from risk-free, covered call writing is considered a perfectly legitimate strategy for many equity investors. The key here is the cash-secured put investor's intent to acquire the underlying stock, regardless of the near-term lows it might hit. So as long as the put writer is comfortable with the assignment and the downside risks of the stock, this strategy isn't inherently more dangerous than a covered call. Of course, the risk is large if the stock falls to 0, but again, how often does that happen? However, that risk applies to all stock owners and covered call writers too. So there you have it, the cash secured put. The downside equivalent to the covered call, and it could earn you some cheap stock for a bullish investor.